We're going to talk about raising money and the ways that you deal with your financial partners in terms of getting them on board. To do that, we have a guy who's negotiated with so many of these financial partners, and that is Jeremy Halpern, who is both a partner at Nutter, as well as a longtime angel investor in brands himself. And he's going to walk us through cap tables and finance and just how you create a really solid, fair relationship with your investors. And we're really lucky to have him here. Jeremy Halpern.
Good afternoon, everybody. How are you? All right, we're insufficiently caffeinated. All right. So this is about a 2-hour presentation. We're condensing down to about 26 minutes. What could go wrong? Just to give you a real quick overview of myself and Nutter. Nutter is a large law firm. We're located in Boston. Our client base is all over the world, and the food and beverage practice is actually spread nationally. In fact, most of our largest clients are not in New England, although some are, but we have very large clients in Massachusetts, in New York, in California, in Colorado, and actually ex-US. So they're all over the place. And for them, we do a lot of corporate work, financing, distributors, a tremendous number of co-packing arrangements where lots of things go wrong for early brands, patents, trademarks, tax, employment. We try and be kind of your soup to nuts support shop. So we work with lots of small brands. In fact, Sibel, see, you're on the screen. Yay. As well as some who are growing and national. And we've had the joy of working with a bunch of them who have made it all the way to the promised land and exits, including some very, very large manufacturers as well. Along with technology companies, some companies you've never heard of, but you eat their food every day because they're often behind the scenes. So some of the exits recently. It's a large team. It's about 27 people now who are spending a large portion of their time in food and beverage. My background, I am a corporate lawyer. I'm also an angel investor. I've spent time at a venture capital firm. I've spent time as an entrepreneur. And so I spend pretty much all of my time doing nothing but hanging out with high-growth companies. My wife tells me I'm so boring that my Twitter handle is, in fact, Startup Boston. That's how boring I am. If you get a chance, take a look at the Nutter website. There's lots of good content there for you guys on our food and beverage page, and there's all kinds of things about some of the topics we're going to talk about today. So it's a good place to go to get supplemental content. And it's just nutter.com, Nutter.com. All right, so what are we talking about today? We're talking about how the economics of investment work. And what you find that's surprising is people use words, phrases, concepts all the time in conversation, and oftentimes they're not using them correctly, or they don't fully understand, and they're a little shy about wanting to understand more. So I always play the same game. I apologize to Carol and Jeff because they've heard it forever, but who had a less useful in business undergraduate major than me? Go. Who? What do you got? There's usually like one arts major. Theater, sweet. All right, we're in the right town. So I have undergraduate degrees in moral philosophy and in medieval history. That's quite the combo. I bring that up to point out that I learned everything I know in finance, in business, in law the hard way by asking questions and being in it for 22 years. The only stupid question is the one you don't ask for fear of looking silly. So you can't, there's no question you can't ask following this presentation or at the roundtables. So what's happening? If you guys go on your Fidelity account or your E-Trade account and you buy shares of, well, today it would be Beyond Meat, let's be honest. When you buy those shares, you are buying them from some other stockholder. That means nothing has happened to that company. In fact, the company will never know it's happened. A transfer agent will have a little book entry ledger, but nothing has happened to the company. Nothing. Shareholder A sells to shareholder B. The company doesn't have one thing happen to it. The balance sheet doesn't change. The value doesn't change. The company has not gotten bigger or smaller. Nothing has happened. That is not what we do in this room when we're raising money. We do a thing called issuance. There's some number of you as co-founders, whether it's one. So if it's one of you, just treat all of you as A, B, and C collectively. But sometimes there's 2 or 3 of you who are co-founders. And you go out to shareholder D and you say, please give me cash for the business. Shareholder D doesn't give you cash. Shareholder D gives the business cash. And in exchange, the business issues new shares. So you go from owning 100% of a thing collectively to owning less than 100% of a thing. That is the concept of dilution. The company got richer. The balance sheet went up by the cash. Your percentage ownership went down. That's the dilution. And the total quantity of shares went up. All right? So how does that look? Let's imagine that the business, you found an angel investor. By the way, this does not apply. We'll talk about how you get to valuation in a second. But just, it doesn't matter where you start with the numbers. All the math works, even if you add another 0 to it. Right? So let's imagine you agree with the investor that the business is worth $900,000, and let's say for whatever reason you've used 900,000 shares as the starting point. Again, it doesn't matter what your starting point is. All the math works even if you've allocated yourself 9 million shares. It makes no difference. In this example, that would mean that the investor is buying at $1 a share, $900,000 of value by 900,000 shares. They're going to put in $100,000. That means they're going to get 100,000 shares. So now you have a company that has 1 million shares, of which they own 100,000. That's 10%. So this is what it looks like on a cap table, pre-post. Before the deal, you owned 100% collectively. After the deal, you own 90%. What's really amazing in the world of early stage finance is how many ways I can leave those 2 things the same. We can agree that it's $900,000 in pre-money value, and we can agree that I'm putting in $100,000, and I can radically change the economics by throwing a bunch of other levers. So one of the things to keep in mind when you're talking to investors is valuation is not the only important thing. There's an old joke in early stage investing. If I'm the investor and you're the entrepreneur, and you say valuation's really important to me, I say, cool, you choose the valuation, I get to pick the rest of the terms. Don't say yes to that. That's a terrible idea. We're going to see some of the ways that happens. So the question always comes up, how do we get to the value? What is the value of the company? And the answer is this is negotiated. This is Craigslist, not eBay, and certainly not NASDAQ. There is no public market for your securities. If you happen to be in the fortunate position where you have more than one investor at the table, you will get an auction value, people competing for the deal. In the absence of that, when you found one investor and that investor is willing to invest, you're going to have a conversation. My cash relative to your pre-existing value, what's the relationship? There's no true in this story. There's just how we feel about these things. And one of the things, how many of you are like ex-bankers or accountants? All right, you're my worst offenders. You do really, really ridiculous things like, well, we're going to create a model and discount the cash flow back. You are discounting future hypothetical bullshit cash flow based on a quantity of risk you don't understand but might be close to 100%, right, to get to a fictional value that you could have just agreed on in the first place. So don't do that. Also, don't use things like net book value, which is, oh, well, we put $100,000 into the company, so the company's worth $100,000. What did that assign no value to? What? You. So you've declared yourself to be valueless. The idea, the brand, everything is 0. All you've said is, well, we have 100 grand of inventory, so we're worth 100 grand. That's a terrible idea. Don't do that. But it's a good minimum, right? If you've put that much quantity in and you think you've built value, that's at least a minimum way to think about it. But this is a negotiated process. And it's worth learning how investors think about exits. Every investor starts every conversation with a thought process about an exit. So if you talk to the Bobs of the world, Bob is a consultant, Betsy's a consultant, they're interested in helping you. They don't immediately jump to this place of, who will buy this for how much? If you talk to an investor, no matter what their lips are doing, it is the only thing running through their head. Who will buy this business for how much? And why? And so you can run models that help you understand how they think about it, but it's really worth getting in the habit of talking and listening to people about how folks think about this stuff. But today we're going to mostly focus on the mechanics. We can spend more time talking about valuation at the tables. This is just a bad joke, but it's a plan. It's not a good one. What's the first lever investors throw? The first levers investors throw after you agree on a value is they say, you know, I agree that this company was worth $900,000, but only if there's a team in place to execute the plan that you've laid out to me, right? You've told me there's going to be someone on e-com and someone on conventional and someone on natural, so that's a bunch of bodies, and you're going to have a field marketer and blah, blah, blah. So I think you're going to need to go hire 7, 8 people, and I think that's going to cost you 10% of the equity, so I'm going to move all of that to your side of the equation. And by what they do is they just create a fictional amount of shares that exist that don't actually exist. Right now, there's 3 of you in our scenario. You have 900,000 shares, and they go, imagine there was another 100,000 shares outstanding. And you're like, okay. Well, what happens? That means that the price they pay per share goes down because the quantity of shares went up. They put in the same amount of money. Remember I said, same $100,000, same $900,000 pre-money. But what's the difference? They still own 10%, but you went from owning 90% to owning 81%, just like that. And you'd be lucky if that's the outcome, because these days, early stage investors don't say 10% of the pre, I don't have a laser pointer, but 10% of the pre-money. They say 15% of the post, which means investor owns 10%, plan owns 15%, and you just went from owning 90% to 75%. We didn't change the value. We didn't change how much cash I put in. Just like that. What else is happening? This is a long dictionary of terms. These are really boring slides. Don't pay any attention to the slides. The idea is, how do investors invest? They invest on a mechanism, one of 3 basic ways: equity, convertible notes, or safes. How many of you have heard of a safe? Okay, the rest of you, you're going to get more familiar as you talk to more investors about this. A safe is just a fancy way to do a convertible note. So let's talk about it as equity and notes, and we can explore the differences later. In equity, what people typically bargain for is preferred stock. Anyone know what the preference means? What is it preferred relative to? To payback. They get the right to the first money. So the first thing the investors figured out was, I want the right to get the better of my money back or my percent. I don't know if I can go backwards. Can I go backwards? Okay. So in this story, if I invested $100,000 for 10%, I have the right as the investor with preferred stock to get the better of 10% or $100,000 if we sold the company the next day. So if we sold the company for $5 million, what do I take? 10%. If we sell the company for $500,000, what do I take? My money back, right? So 100,000 out of 500, I'm getting 20% of the proceeds, not 10%. Right? So I get the better of A or B. The next thing investors figured out was, hey, you know what? I can tell you a very sad story about, it's very hard to raise money, as you know, and I went out and I raised money from my limited partners. And so that's costing me, my cost of capital is like 7-8%. So I need an accruing dividend. So now it's not just the better of $100,000 or 10%. Now it's the better of $100,000 plus 8% a year or 10%. That doesn't sound like much. What happens if you've raised $10 million and the company's taken 7-8 years? That's a big stack of cash that's coming off the top. Okay. When I was at Disney, one of my claims to fame was I helped bring back Schoolhouse Rock. And so I say that to tell you that it's conjunction junction time. There's like 17 millennials in the room, Bob, who just went, I have no idea what that is. Whew, that was rough. So investors thought, I don't like the better of A or B. You know what I really like? And. And is a much more friendly word. I'll take A and B. I will take my money back first, plus potentially that dividend, and then I will take my percentage interest of what's left. That's called participating preferred. Okay, how does that go wrong? I was part of a business. They had raised $21 million. They had $31 million of liquidation preference, meaning they had promised people the last round 1.5. Right? And so that $31 million was coming off the top, and then they were getting another, at that point, 80% of what was left. So even if you hear in the news, oh, business sold for $50 million, and you think, here's an entrepreneur, sitting on a beach, drinking tequila. Nope. The founders in that deal got nothing. Zip. That's what happens when you agree to really abusive terms and you don't grow value fast enough to make it worth your while. Let's talk about a couple other levers they throw. So we said the liquidation preference was their money back. They can make that 1x, 1x, meaning the amount of money they invested, or they can make that more than 1x. I just did a deal. $15 million came in. The company had to agree for a whole variety of reasons to a 2x liquidation preference. That means the investors, in this case, got the better of $30 million, and what they bought was roughly 42% of the company. What that does from an interesting kind of thing you don't see coming is, if you sell control of the company, so let's say you do that deal and you do one more deal, and now collectively the investors own 55% of the company. And the investors look at that and they say, you know, we have an offer on the table for $60 million, and we can turn our 15 into 30 in that story. Or we could spend the next 5 years to try and grow it to $100 million. They are literally economically indifferent. They'd say, nope, I will sell it today because I make the same $30 million at a $30 million exit as I make it, in this case, at an $83 million exit. The exact same amount of money. And if they're in control of the company, they're going to make that decision every time. They're going to de-risk it, take their cash, drive their rates of return because they got the cash back faster, so it looks good for their limited partners. They're indifferent. What happens if they sell it at 30? How much do you get, founder? Zip. Nada. Zip. That's pretty painful, right? And again, even if they sold it at 35 and you say, oh, okay, that's $5 million left over, that's for you and your entire team. That's all the common stock, all your consultants, all your employees. Everybody's splitting that $5 million. So in a preferred stock deal, you know how much of the company you're selling, but the percentage that you're selling may not be the same as the percentage of the economics. There's another way to do it. How many of you are, if you're willing to share, less than $3 million in run rate revenue? Okay, so most of you go off to an investor, you have a conversation about valuation, and they say things you don't like to hear, and so you say like, if only there was another way to do this. And then you go and you read the internet, which is always the wrong answer. And you come to the conclusion that instead of selling stock, what you're going to do, this is all just there for your reading. We can talk about it later if you want. What you're going to do instead is you're going to sell convertible notes. Because convertible notes aren't priced today. They allow you to build value and price the deal later based on later events. How many of you are at least aware generally that that's the scheme? Okay, so convertible note says, I, investor, give you some amount of money. Here's $500,000. How much of the business do I own? No idea. It says I have a bunch of rights to turn that $500,000 into equity on the happening of a bunch of things, and we need to know about 7 or 8 data points to know how much of the company that will buy me. It's undetermined. So you think this is great because by the time we get there, I'm going to have built value. Maybe. So, first thing to know, bridge not appear. Bridge not appear. Convertible notes are only interesting things to do. They're only helpful to you to reduce dilution, meaning reducing the quantity of the company that's shifting to the investors, if you are building value quickly. If you are at a steady state, if you are building at 5 or 10 or 15% a year, a convertible note is a disaster for you. Why? Because convertible notes have a couple of things, right? We're not going to price it today. The investors are going to give you some money today, and they're going to say, you know what, we'll price it tomorrow, and in exchange for taking that extra risk, I'll get a couple of fancy terms. So one, I get interest. Interest rates tend to range between 6 and 10%, simple interest. And what that means is if you're paying an investor, let's call it 10%, but you're building value, you're only building value at 5%, you're already behind. By the way, it's a balloon. You don't pay interest. This is not rent payments or a mortgage payment. You're only paying the interest at the conversion, and you're paying it in equity. What else is happening? they say to you, well, you know, if I'm going to convert my investment based on what the next investor pays, that's the usual trigger called a qualifying financing. So it says, I give you $500,000, you go out, you find some investor to do at least $1 million, and I agree my $500,000 will convert as a function of that deal, that price. But you might know a couple of idiots. All of you in your head just pictured someone, FYI, like that was great. You're like, yeah, I definitely do, right? You might know a couple of idiots, and that idiot might be willing to give you some outrageous price. So I, the investor, say like, I can't risk, you know, brother-in-law deal X, so I'm going to agree on a cap. I'm going to say my investment cannot convert at a higher price than X. Caps are bad for you, good for investors. Bad for you, good for investors. Particularly if it's a Yankees cap, bad for you. That was like a know your room moment. I failed, Carol. It's fine. Caps are bad for you, good for investors. What it means is, let's say somebody would have given you a $3 million price today, and you say, nope, and then you gave them a note with a $3 million cap. All you've done is said, the best I can do is the deal they would have given me, but the worst I can do is if the next round investment is at $1 million, I'm going to take way more dilution. So that was silly. Right? So the cap has to be above the price that somebody would be willing to invest in today. Next, they get the better of the next price less a discount or that cap. So, next investor, you said, investor shows up and says, hey, I'll give you a $3 million cap. And you think, okay, I can do that. I can get someone to pay $3 million, but it's not $3 million. You've got to get someone to pay close to $4 million to convert old investor at $3 million, because they get the better of 80% of that deal, right? If they have a 20% discount or that cap. So if you do the next deal at $3 million, the investor, my $500,000, it's going to convert at $2.4 million. Just like that. So you've got to be building value fast. You got to get past the interest. You got to get past the discount. These are the types of things that cause conversion: the maturity of the note, a qualifying financing, an unqualified financing where they have the right but not the obligation, or a sale of the business. So why do people do notes? Because they're cheap to document. You get to pay me a lot of money when you do an equity round. Equity rounds will cost you, if you go to an institutional angel group or venture firm, your side of the deal, your legal fees will be somewhere between $25,000 and $60,000. You will also get to pay their legal fees. Yay! If you go do a note deal, that can be anywhere from about $4,000 up through about $15,000, depending upon what the nature of the deal is. There's kind of different flavors of it. So it's cheaper. It's also high velocity, meaning I can paper each note as a separate thing. I can say, okay, I'm going to give note here, note here, note here. They don't all have to be the same terms. High velocity, I can do it quickly. Versus in an equity deal, everybody's going to get the same thing. So I better be sure what that is, and that means I have to usually arrange a quantity of dollars in order to justify the transaction fees, right? If you raised $100,000 in preferred equity and you paid a lawyer $30,000, that would be bad, very bad. Don't do that. Because they're notes and they convert it the better of the next round or not, that's the equivalent also giving them a full price protection. You've just said if things go sideways, they get all the benefit of that. If things go up, they're subject to a cap, but if things go down, they get all the benefit of that. That's a dangerous thing to do. So if you're growing quickly, or you believe you can grow quickly, notes can be a great thing. If you've kind of been flatlined, and it's been going like that for about 12 months, notes are a very dangerous thing to do. So just to remind you, I'm going to contrast these, if I can do this correctly. Convertible notes, cheaper to document, higher velocity. You don't need to agree on a valuation, but you may need to agree on caps and discounts. There's limited control rights. You're giving people full downside protection. Priced equity, you're giving people lots of rights, and it's expensive to document, but they're now an equity investor just like you are. Okay, so let's pause there for a second. Just checking on timing. So we've got 5 minutes. I have like an hour and a half more of content, but let me pause and ask questions. Yes.
Hold on.
Oh, sorry.
How would you identify or some indicators to differentiate between strategics and let's say predatory angel investors?
Okay. Depends who's in the room, right? All investors are trying to make a return, okay? And before we all think, oh, investors are like terrible people, how many of you have a 401k? Raise your hands high. Yeah, P.S., it's your money they're investing. Those 401ks put their monies in fund to funds. They have an alternative asset allocation. They take 10% of those dollars. They hand them to fund to funds. They hand them to venture firms. You are the limited partner. So those folks have a fiduciary obligation to get return for you. So before you think, ooh, they're terrible, don't. They have a job to do. You got to know what they are and what they're not. When you say strategic, usually people are talking about large institutions. So most of the major CPG companies that Betsy was talking about who are losing share, one of the things they did was they went out and created venture units. I've done deals with Pepsi, Anheuser-Busch, Coke, Danone, right? All of them have some venture unit. So that's a, in theory, strategic deal because what they're doing is they're investing dollars and then they're putting commercial resources side by side. These days, we're seeing some folks do that from co-packers, which sometimes works, or ingredient houses, but it's hard to know how much value is being put in there. So the contrast isn't between predatory and strategic. The contrast is between a pure financial investor who says, here's some cash, good luck, versus a strategic who says, here's some cash, and we have some business relationship on the operational side. I'm not sure if I fully answered your question, though. Okay, all right.
Along those lines, though, what are your thoughts on NDAs when dealing with investors?
Venture firms will not sign NDAs at the beginning stages, nor should they. I don't care how special a snowflake you think you are. They have seen a plan that looks awfully similar somewhere between one more time and 100 more times. Right? So that investor is not going to agree, oh, somehow you telling me your concept for super extra sugar cornbread somehow makes me, right, not able to talk to other people. What they will do, though, is once you get further into a conversation, they will sign an NDA before you start giving them detail-leveled information, right? But you have to give them a fair bit of information without an NDA, typically. They'll need to see top-level financial information, trailing 12 months revenue, usually for a couple of years. If you have it for a couple of years, your gross margin analysis, key vendors and accounts. So they'll get at least that level of information before they're going to sign an NDA. You should never, ever, 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 ever give investors access to your formulations. They don't need to see it. There is no reason on God's green earth to see it. If you are doing a deal with a strategic and part of it is that they're going to be in the build process, then you will have an NDA. So if you work with a group like a Doler or an Ingredient or somebody like that, you're going to sign an NDA to protect that piece of information.
Here, hang on a second.
Thanks, Jeremy. That was actually really helpful. Could you touch on safes? You said you might
sure.
do that. Thanks.
Safes are kind of a better for you, the entrepreneur, kind of note. It's the same idea. I give you some money today for an indeterminate amount of equity tomorrow. Unlike a note, they don't bear interest, and they don't have a maturity date. So the thing that people worry about with notes is they're a debt instrument, and they're stated as debt. So if I invest in you and you give me a note back that says 12 months, and at the end of 12 months, you haven't done the thing to force me to convert. A qualifying event is a thing that requires me to convert, as opposed to my option to convert. If I am not forced to convert and I hold the note, I can say, great, pay me back my $500,000 plus interest. By the way, will you or will you not have cash at that moment? Never, ever, ever will you have cash at that moment, right? You guys are burning cash. You are in the trough part of the hockey stick. So the fear is that the investor, if they call the note, can end up owning the asset for just the debt, meaning they've bought 100% of your company for the value of the note. With a safe, that can't happen because there is no maturity date. So they're pre-buying without the same protections of a note.
I guess I was just curious why investors we're actually raising on a safe and we have some money in, but I've heard like, oh, you may not want to do that. Investors don't like that.
Well, because investors prefer the optionality of a note, right? That I'm debt until I'm equity, which means I have the rights of a debt holder until I'm an equity holder. So investors prefer it. It's also easier for many of them to understand. Safes are effectively a prepaid equity warrant, and they're relatively new. So particularly if you went to folks who'd been doing it a while, they had to learn something new. And anything that you have to get an investor to understand that's new and different is a speed bump in your investment raising process. So it's easier to raise on notes. You're giving them more, and there's less explaining to do. But by the way, whether you do a SAFE or a note, you'll have a conversation that goes like this. You'll call your lawyer. You'll say, we're going to do it a note, right? Cool. And then you call them back and say, the investor wants to know how much of the company they own. And we say, I don't know. I can't know. I can give you an Excel sheet that says if we fill in the following 7 or 8 data points, then that will be true. But I can't know. And you'll go, okay. But they still want to know. Like, I can't help you.
We have time for one more very quick one here.
Thanks. And hopefully this is quick. It's tough to generalize, but how favorable would be the terms for a first investor versus subsequent ones?
Meaning what's the spiff you give to somebody to tip in? So we like, I don't know if you saw it on the slide, but we like to do notes on an inclining basis, meaning that the discount goes up the greater in the span of time between the time you do the note and the time you do the qualifying financing. That bakes in an incentive for someone to get in earlier because it says, we usually do them every 90 days, it goes up 5% to a max of 20. So if I'm in 270 days, I'm going to get a 20% discount. If I'm only in 90 days, I'm going to get a 5% discount. So I have an incentive to get in earlier. So those take care of themselves, which is nice. Other times people will do more complicated things. And simplicity is, like, I like cashing checks, but simplicity is your friend. So you'll occasionally see people who say, oh, I'm going to do some warrants for early movers, or I'm going to do something else for early movers. Those are often more complexity than you need to get people to tip in. But certainly with debt, the idea of staging it based on time helps you motivate people to be that first in. Sometimes people will just say the first $250,000 is getting a 20% discount, and the next $250,000 is getting a 10% discount. Same idea. And with that, we are out. Thank you guys very much.